Equities do have the highest expected return, but with that comes increased volatility of returns. And when you have increased volatility of returns, you've got more uncertainty. In contrast, there's other assets like bonds, T-bills, non-callable deposits and cash, and they generally exhibit lower volatility of their returns. And with that comes lower expected returns. So if you're an investor and you've got an equity-heavy portfolio, you might add some of those lower volatility assets like bonds and T-bills and cash, and then that will reduce the overall volatility on the portfolio, but that will also reduce the expected return. So there's a trade-off. So rates rising are important for your portfolio even if you don't have a fixed income exposure. And with rates at historic lows, a couple of things have happened. One is the discount rate has declined, and that means that it's pushed asset prices up. The other is that investors have been seeking yield, and that's also been pushing asset prices up as well. So that means that if we have interest rates rising, that's going to be putting pressure on asset prices. It's going to make them vulnerable. So one way that you can protect your portfolio from both rising and falling interest rates is to invest in non-directional strategies. And an example of that is a relative value type strategy. And these types of strategies really seek to identify mispricing between different types of securities, but they have to be related to each other. And in this way, they usually trade in line with each other. They have the same exposures to the same risks, but they might be priced differently. And in this way, you can isolate that market mispricing. And then only get exposure to this pricing, but chop out any of the market risk. And the way that you would do something like that is, suppose an investor identified that a bond was trading cheap to a bond future, then the investor could buy the bond, sell the futures, isolate that mispricing, and then they've stripped out any of the market risk.